Well, it was a real sluggish session, right? We are on the eve of the jobs report, and that could set the tone really for the market and the Federal Reserve for the remainder of the year. Now, one issue for investors is where to invest, right? We've been talking about this. If tech stocks come under pressure, and that's certainly happening. The last month, we've seen rotation into other niches of tech, mostly semiconductors. Unfortunately, today, those names were crushed after cautionary comments from Micron about DRAM and NAND pricing. There's also some buying in software names. After the bell, Palo Alto Networks had a pretty good move, so did Finisar, but let's face it, those names aren't big enough to pick up the slack. Now, beyond the near-term struggles with the market leadership, there's still the question of the underlying strength of the economy. It is phenomenal. You know, one stock I love, Old Dominion, moved to an all-time high today. It's a trucker. Now, coming into the week, the Atlanta Fed model had us at 4.7% growth this quarter, and a strong jobs report tomorrow could move the needle even higher. The question, though, is should we be rooting for a strong jobs report? Consensus around 190,000 strong wages. You know, it could actually maybe have a negative response, right? Remember what happened in February when we had a strong move in wages. This morning, by the way, the New York Fed Vice Chairman John Williams gave a speech that many observers saw a shift from being a hawk to a dove. If that is the case, coupled with comments from Jay Powell recently, maybe we finally have a Fed that will allow Main Street America to get a pay raise without putting the brakes on the economy. Here now to discuss Danielle DiMartino Booth. She's a former Dallas Fed advisor and now CEO of Quill Intelligence. All right, Danielle, did you hear this speech today by this? He's a voting member of the FOMC.
He's the second most powerful person on the FOMC.
Sounds like he, in my layman sort of thing, sounds like he's a little dovish, like he's not in a hurry to derail this thing.
You know, yes and no, because he also said that the yield curve doesn't matter, and we've been talking about the yield curve for months and months and months. It's at the narrowest that it's been in some time. But yes, he definitely leaned a bit more dovish, and that leads you to believe that as the market is beginning to move towards it, that September rate hike is definitely a go.
That's in the books. I mean, that's a 99%. Everyone believes that's going to happen.
But investors right now are hyper-focused on December. And the evidence since Jackson Hole has continued to accumulate that we might not see that rate hike come December.
You know, this is where people get frustrated, that the Federal Reserve, you know, created $3.5 trillion out of thin air. $4.5 trillion to prop up the banks. Mm-hmm. And as soon as they see that maybe someone in Butte, Montana got a 3% raise from a year ago, they're ready to slam the brakes on and stop this whole thing. How do you juxtapose that?
And that's called irony, Charles, because you actually want to see the people in Butte, Montana getting these pay raises. It's the kind of inflation that the Fed should treat as being friendly. It is actually why I'm heartened by Jay Powell. And the thing that the media missed when he was in Jackson Hole was that he said that, you know what, maybe inflation, the way that the Fed measures it, isn't the way for us to dictate how monetary policy should be made. Maybe we should be paying closer attention to the financial markets. And for there to be a new generation, because we're talking about since Alan Greenspan took office, for there to be a new generation of central bankers who say, let's pay more attention to the common man, to commonsensical evidence that's in front of our faces, as opposed to model-driven data that tell us things are going right or wrong or in between. I applaud what he's had to say, because I think that he understands that there's good inflation, as you're alluding to.
Well, real quick then, he's not a classically trained economist. He's a Wall Street guy. Does that work in our favor in your mind?
Oh, absolutely it does, because he understands, as he said in his speech, that inflation cannot be the only determinant of where the economy is in the cycle, but we also have to pay attention to where the financial markets are and where excesses have bubbled over, which led us into the last two downturns. So he's a pragmatist. I welcome him.
All right. Well, we welcome you. Always appreciate your expertise. Thank you very much.
Thank you.